All right, let's talk about Ford Motor Company. Right now, its stock is in this incredible tug of war. You've got the bulls on one side, convinced there's plenty of road ahead for more gains. And on the other, you have the bears, pointing to some pretty serious warning signs that a reversal's coming. So who's right? Let's dig into the data and see what it's telling us.
So what are we really looking at here? Is this a classic bull trap, just luring in hopeful buyers before the bottom drops out? Or is this the real deal? The start of a genuine breakout that has a lot more room to run? That's the puzzle we're going to try to piece together.
Before we jump into the thick of the fight, we got to get the lay of the land, right? So let's take a look at a few key numbers that are really setting the stage for this entire battle between the bulls and the bears.
And here's our starting line. Ford is currently trading at $13.21. This is the number right at the center of our tug-of-war. And it's important to know this price is actually near the top of its 52-week range.
Now this is pretty interesting. Its beta value is just 0.306. In simple terms, that means Ford's stock is way less volatile, less jumpy than the overall market. So if you're a conservative investor, you might see that and think, great, stability. But if you're a more aggressive trader, you might see it as a stock that isn't going to make those huge, fast moves you're looking for.
And here we go, our very first red flag for the bulls. The risk/reward ratio is sitting at 0.406, and that is considered unfavorable. This is a big deal because it basically suggests that from this price point, the potential downside might just be bigger than the potential upside.
So what does that actually mean? Well, think of it this way. For every single dollar you're putting on the line, how much could you realistically expect to make? A ratio like this one is whispering, maybe not enough. It's a pretty strong hint that the big, easy money might already have been made.
But hey, that's just one data point. The bulls have a really compelling case of their own, and it's built on some powerful signals that show some serious underlying strength. Let's take a look at their side of the argument.
Okay, now this is where things get really interesting. See, while some of the volume numbers are kind of mixed, the key accumulation/distribution indicator is strongly positive. And we're not talking a small number here, that's over 1.3 billion. This suggests that even with all the noise, the big players, the so-called smart money, are quietly buying up shares. That is a powerful sign of hidden strength.
And here's the absolute bedrock of the bullish case. The current price, $13.21, is sitting comfortably above all the key long-term moving averages. You've got the 50-day down at 1214, the 100-day at 1172, and the 200-day way down at 1083. I mean, this is basically a textbook picture of a healthy, established uptrend.
Okay, so the long-term picture looks pretty good. But, that's only half the story. Now we've got to flip the coin and look at those storm clouds the bears are seeing gathering on the horizon.
This slide, right here, perfectly captures the core conflict. On one hand, you have that strong uptrend. But there's a catch. A linear regression model, which is really just a fancy way of calculating the fair price based on the trend, it suggests the stock should be trading lower. The fact that it's trading higher is a strong signal that the stock might have gotten a little ahead of itself and could be due for a pullback.
And the warning signs don't stop there. We've got multiple indicators flashing yellow. The stochastic indicators are up in a high range, a classic sign that a stock is overbought, meaning it's gone up too far, too fast. The price is also bumping its head against the upper Bollinger Band, which often acts like a ceiling. And when you throw in that unfavorable risk/reward ratio we talked about, well, the case for a pullback starts looking a lot stronger.
So, you have a strong trend fighting against clear signs of exhaustion. How in the world do you make sense of all that? Well, the analysis boils all this conflicting data down into 3 distinct scenarios, each with its own probability of what could happen next. So what does it all add up to? Here are the odds. The analysis gives a 40% probability to the bearish scenario, the pullback. Then you've got the bullish and neutral scenarios tied at 30% each. The takeaway here is pretty clear. While anything can happen, the data suggests a pullback is the most likely path. Caution is definitely warranted here.
Think of this table as our battle map. For the bears to really win this thing, the stock needs to break below that support level at 1303. For the bulls to take control, they've got to push it past resistance at 1332. And if it stays anywhere in between, we're just in a neutral holding pattern. These are the key levels everyone should be watching.
So, after all that technical analysis, what does it all really boil down to? Let's simplify everything and focus on the 2 most important numbers that are going to decide who wins this tug-of-war.
In the end, it all comes down to this really narrow channel. The entire battle is between 1303 on the downside and 1332 on the upside. A break of either of these levels will likely signal the next big move for Ford stock. Honestly, this is the single most important takeaway from our entire analysis.
So there you have it. A powerful long-term trend is clashing head-on with signs of short-term exhaustion. The data gives a slight edge to the bears, but, this fight is far from over. Now that you've seen the evidence, the big question is, where do you place your bet? Do you go with the trend, or do you bet on the pullback?